Hello, welcome to this session on the Dcf valuation itself. If you've been practicing all what we've been doing from the start of this training up until now, I'm very happy for you and I'm sure you are seeing good progress. Just to recap, we started with creating the model template from a blank Excel file. We created the summary sheet, the table of content, and this is navigable, meaning you could click on any one of them and it takes you to that particular sheet. That reminds me, I think we should do something to make it possible for us to go back to the table of contents. Okay, so we'll do that right now. I'm going to come over here. I'll say go to table of contents. And notice I am picking only this sheet. I'm not doing that across all the sheets at once. If you try to do what I'm doing right now across all the sheets at once, you're not going to see this option to do a hyperlink. Okay, so you're going to do it on just this sheet, hyperlink to table of contents, and then that is what we will copy. So I'm going to copy this, pick this all the way to financial ratios. Let me just go check where column O. So I'm going to redo that part. So on the cell in column O, I do the paste, I ungroup sheets. So with that, I can be able to go back to table of content from anywhere I am. So that is another nice feature to add. We created the model input sheet, the directors and staff controls, the scenarios, the revenue, the cost of sales, the working capital, the depreciation, debt, equity, tax, income statement, balance sheet, cash flow, and now we have to do the DCF. But just to let you know that what we've done is a very dynamic model. So if I go back to table of contents, and remember we created scenarios, right? So far we've been running on the conservative scenario. What if I change this to optimistic? So changing this to optimistic, all of this should change. So income statement should have, before this were showing 30 something percent net margin. Now they've all gone up, right? And balance sheet should still balance, hopefully. Yes. So you see what we've done, it makes sense, right? The cash flow still balance. And if I also change this to the pessimistic, let's check if things will still keep working nicely. Income statements, we can see the net margin has dropped. The balance sheet still balancing. The cash flow, so you see it recomputes, right? So that's the whole essence of creating is you are able to do something that is very dynamic for your client, or if it's an internal task, your team, you're able to put your plans in, change your plans, and you see the effect instantly. So I'm going to change this back to the conservative, and we will do the DCF. So for the DCF valuation, we need to extract out the unlevered free cash flow. So if I think it's just best to do that in here. So I'm going to do a new line here on the cash flow statement, unlevered free cash flow. UFCF. Okay. So the meaning of this is, it's sometimes a bit tricky to explain for people who are not so familiar with financial statements. But then I will just try to show you what the whole concept is about. So in DCF valuation, what you're trying to do is you're trying to extract out the company's value. So this is what DCF valuation attempts to do. I'm going to minimize this. Okay. So you're saying for a company, so DCF valuation So say this is a company, whatever the name, ABC Limited. The value of the company is what all the money the company will make. So the cash flow that you're going to get from the company year 1, cash flow year 2. So you get the whole pattern. All the cash flow the company will make up until year infinity, if possible, right? All those money discounted to today's value. So you are discounting it to today's value. So that's where that DCF name comes from. So the thing is, when you're discounting the cash flow, you want to be sure that you're discounting the cash flow that comes strictly from the company's operations. What comes strictly from operations, then after they've put back money into the capital assets, all of that, you are not wanting to add the money that comes from financing activities, because these are money that are not coming from the operations of the company. If you buy a company, you are buying it for what it can generate from its own operations. So what money you make from the day-to-day run of the company, plowing back into expansion of the company. So those two, that forms the free cash flow from operations and investing. You don't want to add the effect of leverage of outside fund. So that's why this is called unlevered free cash flow. But then we need to remember that there's usually the effect of a tax cover. There's what we call a benefit you get from, because tax is interest expense deductible. So meaning whatever interest expense you've paid, the tax that will be computed for you is going to be after that. So we need to adjust for that. We need to do like a separate version of this company where it's not having any interest expense. Let me rephrase that. We need to do another version of this company where the interest expense is going to be, we're going to take out the effect of leverage, because interest expense is what you pay to service a loan, and then that is also reducing your tax benefits, I mean your tax expense. Already we've taken out the effect of interest expense by not including the finance cost, which by not including these financial activities. But we also need to take out the effect or it is having on tax. So look at this year, for instance. If I had another line and call this so usually sometimes we call it the operating tax. So which means if I tax exactly the money without considering these finance costs, maybe I'm going to leave the finance income for now. So if I tax just that, which means if I say the tax is, let's do for this, the tax is equal to this, I take out the effects of interest expense, right? And this is what I multiply by the tax rate. So the tax rate is 30%, right? If you remember, that's the tax rate we've been using. You can go look that up in the tax schedule if you've forgotten. Then this is the actual tax the company would have paid if there were no, let me just put it in minus. if there were no if we take out the effect of the finance costs, right? So now this is what I need to adjust back to. So the thing that makes it very easy to do is just, we call it interest tax cover. Is just to say interest tax cover is actually equal to whatever you are paying as the finance cost times the tax rates. And if you look at this, this gets me the difference between these two values, right? So if you adjust for this, if you okay, I don't need to do too much. I'm going to drag this figure here so that you can see. And if I take this and I add it with this, you see that I get exactly the same amount, right? So if I need to compute what really our operating cash flow is from without the effect of the finance cost, right? It means I need to take this in computing my net income. Then it's going to be profit before tax plus this one. So this is my actual net income, which should have gone to this line here. So I need to take out the effect of that interest tax cover. Interest tax cover. I'm going to say all of this NGN. And this is not difficult to compute. This is just going to be equal to cash flow from operations plus cash flow from investing activities. And this we've already done. The concept is I multiply the finance costs by the, I'm going to go pick the tax rate directly here so that everything can be dynamic. Okay. Now I drag these two. Okay. And then the real cash without the effect of leverage is the summation of these two. So this will take out the effect of interest, the tax cover we get from interest, which is one of the benefits of you having a mix of debt and equity funding, because you get, it reduces your, it boosts your cash kind of, it reduces your tax liability and it gives an optimal, there is a particular mix that gives you the optimum value in terms of you see an increase in your cash flow without you actually having to do more from operations. So that's what we are removing the effect of. And just to reiterate, if this company, so let's check it out. If this company had no, you can see this figure, right? I'm going to copy it, paste here as value, maybe make it have a comma format, right? So I'm going to do as we usually do. I create a new window. I move this to the right, and no, this is not the one I want to be on the left. This is the one I need to be on the left. Okay, so this goes to the left. And so let's do the test, right? Just to help you. I know it's a bit tricky. You might need to go read up extra on this if you are still confused, but then so you don't get confused about the logic at all. What we are trying to do is we are trying to remove the effect of leverage completely. And when we say leverage, outside money, especially debts, right? Loans and all of that. So by omitting all of what comes from here, we have removed a large chunk of that. So that is what we did here. But then there's another aspect of debt that is here that is affecting our net income. We need to remove that effect also. So I want you to watch this. Okay, so you're looking at this line, right? Okay, good. I'm going to, particularly I need you to look at these two items. Let me color this in yellow. Okay. And this also in yellow. Okay, so those two line items. So if I say this company, there were no debts, so we didn't borrow any money, I knock off that effect. Are you noticing that I need? Okay. You'll notice that this and this becomes the same. This and this becomes the same. These two are really close. The difference you are seeing is just based on the cash, the interest on cash here that we have here. That's what is causing that difference. If we don't earn interest on cash at all, if I knock this to 0, then you will not see this difference you are looking at here. But then you get the whole concept, meaning that what we are trying to do is purely to extract out what the free cash flow will be without any effect of leverage. So I'm going to just return all of this. That was just to demonstrate that in a very practical way to you, so you don't get too confused. Okay, so I'm going to also remove these. I just wanted to demonstrate. I'm going to take off these, take this off. All right, and okay, so that's it. Now that I've extracted the free cash flow, we need that information for, I need to put this back. Yes, I need to put this back. Good. All right, so we're back. So I need to, with this information now, we can go ahead to creating the DCF itself. So for the DCF itself, maybe for now I'm going to make this back into full screen, maximized mode, and then I start the DCF valuation. So for the DCF valuation, most of the work is already done with the financial model we've created. So we're just going to be reusing what we have done in the previous section. So this is DCF valuation, and we need to compute the weighted average cost of capital and then the perpetuity growth rate. Perpetuity growth rate, small g, and maybe I should make this and I think I need to grab all those things I need to use again. So I will grab this as usual, come here, I paste, okay, and then what we need that unlevered free cash flow. Yes, we also need, I need the discount factor, and then the present value of the unlevered free cash flow. So these are the things I need. I'm going to put a line below that, and since we are going to start from the future, and future in this case starts from, let's see, so let's say we start from, if you're valuing the entire company and say we're starting from 2019 for that valuation, then great. So I knock off all of these as not being needed. So one approach I use is what we did already in scenarios, where I go to fill, I go to pattern, I pick the fourth pattern. So I say, you know, you are not meant to enter anything in those ones. So the other sections that we need, let me just write out everything first, then we compute them. So the present value of those cash flows, so of the PV, of the summation, kind of PV of the UFCF, that's from there we can get then the company doesn't just stop, because we just have done for how many years? This is 5 years. 1, 2, 3, this is 6 years. The company is going to exist after 2024, so we're going to compute the continuing value. And then the present value of that continuing value. The summation of those two will give us the enterprise value, what the company really is worth. And if we want to compute the equity value, you can knock off the financial liabilities, the cash, and all of that. So, but for this case, I'm going to stop at the enterprise value, and that's what we want to compute right now. So I'm going to say this is the major thing I want to calculate. And as you will have noticed, I like to indicate the currency sign. Okay, so we can begin. I drag this to the right. I need to extract out the unlevered free cash flow. So this is the unlevered free cash flow. I drag these for the other years. So let's say okay, and I'm going to expand this. So now we need to compute the WACC and the perpetuity growth. So one up to make this stand out, sometimes I like to give it background color. And if you remember, we did the border style the other time, where if I pick white, okay, all right, so that's done. So for the WACC stands for weighted average cost of capital. And it is equal to the equity divided by the equity plus debt. Okay, times, so maybe all of this in bracket, times the cost of equity, then all of that plus into bracket debt divided by equity plus debt, and times cost of debt times 1 minus t, because there's a tax advantage to having debt. Okay, so this is the formula for it. Okay, and the truth is, for a startup, if you're just starting a business from scratch, like as we're doing for this startup here, you can't, there's no, it's okay, it's a bit tricky. So you will need to know what terms the company. So let's go look at our year one. So if we go here, let me move this to the right. Let's start filling in the stuff. So what's the equity? What's the debt? What's the cost of equity? What is the cost of debt? What is the tax rate? So we can start that. So for a company that we are starting, and this is the basis around the operations, you will see that in 2019, the company took a 50 million naira loan. So that's the debt. Also, you can pick this from the balance sheet. So maybe we just go pick it from the balance sheet. The problem with balance sheets in this case would be to give you the end of year. So let's pick this. This gives us the beginning of the period. So I'm going to just use this straight up. So what it is before the company began operation, before this 2019 year end. So the equity is 100 million naira. Debt is 50 million naira. The cost of equity, we leave that for now. The cost of debt is this 20%. The tax rate is, it's this 30%. So we have the bulk of the information we need. And for the cost of equity, typically we use CAPM, Capital Asset Pricing Model, right? And the formula around it is risk-free rate plus beta into market return, total market return, minus the risk-free rate. So the tricky thing about a company that you're just starting is there's not going to be a beta. So what you will have to do is go pick, you will have to use a proxy. In Nigeria, risk-free rate is taken to be 10% currently. So we're going to go get a beta for a similar company. So the proxy I'm going to use is, there's another company in Nigeria called May and Baker. They're into healthcare, though they do a bit more than what we have outlined for this company, but then it's a good proxy to use. So I'm going to go online. So this is the method that I found to be easiest. If you go online and you say May and Baker share price, for you, whatever company you're using as a proxy, so it must be a company listed on the stock exchange, because the very definition of beta is how the company typically moves in tandem with the general stock market. So you cannot have a beta for a company that is not trading on the stock exchange. So you just look for what company you consider as a good proxy, and because the beta are always computed for us freely by most of these websites, especially FT. So if you see something, a result by Financial Times, I will advise you just pick that, and instantly on the page that comes up, you're going to see the beta. So it's computed, it's a measure of volatility. So with this, I have the beta I'm going to use, 1825. 5. Then the total market return. In Nigeria, the total market return is currently about 17%. Long-term market return. There's a formula for that if you want to compute. There's a formula in Excel called RRI. So if you want to use that formula, if you are in a developed market country, say USA, most times you can get this information online without you having to compute from scratch. But if you checked online and you can't find this RM stands for total market return. Total market return and long term. So if you can't find this information, this total market return, long term market return, let me copy and paste here so it's easy for you to see. Okay. If you can't find that information, then you have to compute. So computing is, you need to, like for us in Nigeria, the proxy is not Nigeria Stock Exchange All Share Index, and in 1994 when it started, it was 100, and then currently it's, so I have an app. So if you're in Nigeria, you can use my app. I have an app that if you go to the insert, get headings, and you type Nigeria in there, and you type Nigeria, you see Nigerian market data. If you click add, I won't click add because I already have it, but when you click add, it's going to add, and you see it here. And if you click on it, so in here I have captured most of the macroeconomic and financial market data that Nigerian like me will like to have. So if you go to stocks and you pick yesterday or the most recent, so you will see the info, you'll see the details about the stock exchange, and more importantly in this case we need the all share index. So we want to see what the all share index is like. So while that is working, I can show you another version of it you can use. So you can go to vip.yourbizhedge/economy, and if you go there also, I have a live dashboard that I use to track all of this information. And when that loads too, I'm going to show you how you pick that information. So let's check if what I need has come out here. I guess because I'm recording at the same time, the speed is not that excellent. Even this too is taking a bit of time. Okay, well, I can continue. Once that comes up, I'll show you how with that I can compute, for year 2020 what the value is, and then the difference in those 2 years. And so I'm going to just wait for it to be done before I finish off that part. So I'll show you how with this you can compute the total market return. So if I have this information, then I can do the CAPM. CAPM is risk-free rate plus beta times the long-term market return minus risk-free rate, and so this comes to 22.775%. So that is the, I'm going to make this white. So that is the weighted average cost of capital for this company I am modeling for. And then the perpetuity growth rate. Perpetuity growth rate indicates that after all these explicit years, the company is not going to die. The company is still going to keep in existence, beyond the explicit 5 years or 6 years we forecasted for, we modeled. So what will be the value of the company out after So we've done year 1, year 2, year 3, year 4, year 5, maybe year 6. Then all of this other period, all of those years, what will be the value of the company's shares? What's the value, not the company's share, what will be the value of the company after that? So that is computed using that. So this is more like a terminal value computation. Terminal value, or what I call continuity. So people have different terms they use. So terminal value or continuity value, whichever term you use, the concept stays the same after these explicit forecast years. Since we have explicitly forecasted for 6 years, then what happens after that? So the company will still be able to grow in tandem with inflation and general market condition, and so that's what this perpetuity growth indicates. So they should be able to, in tandem with general market and inflation, the company will still be able to grow their earnings, grow their cash flow. And typically for us here in Nigeria, the long-term GDP is about 5%. The inflation is slightly above that at 7% long-term. So picking a value that is in between those figures is usually the recommendation. So I'm going to go with 5%. So depending on how critical you feel the industry is and how well the company is going to stay, if it's in a very disruptive industry, then where things you don't see the company maybe existing is in its current state for too long, then you might be picking the bottom of the range. And if you feel the company is providing an essential service, as a very strong fundamental, will be able to raise price generally, long into the future, then you can maybe pick a slightly higher, something closer to the upper bound. So it's typically, like I mentioned, between long-term inflation and long-term GDP growth rate. Alright, so you don't want to pick a figure that exceeds both of them, because you can't grow faster than inflation and your GDP, and you will soon be bigger than the entire country and the economy. So that is not practically possible. Alright, so with that done, we can now compute the formula for finding the discount factor. If I know the year, so to make things easy, I'm going to put the years up here. And say the discount factor is based off the WACC anyway. So this is going to be equal to 1 divided by 1 plus the WACC, which is the discount factor, and then raised to power how many years are we discounting from. Okay, and I'm going to drag that forward to get for the future years, and with this I can say this times this to give me what the cash flow will be. And if with that done, I can do the summation of all of this as the present value of the unlevered free cash flow. So now for perpetuity growth, the formula is, let me get my pen. Okay, so for perpetuity growth, the formula is the cash flow in year, so from this moment onwards, right? So which means year 6, 7, year 8, year 9. So all those years, what will be the cash flow? Year 7 is going to be equal to the year 6 cash flow times 1 plus that small g, because that's what we said, that the company will be able to grow revenue at that small g, right? So this is now what we are going to say divided by the WACC minus the small g. So this will get us the continuing value. So it will get us what the company is worth when you take all this money and you discount back to this period. So doing that right now, this is going to be equal to year 6 cash flow times into bracket 1 plus that small g, then divided by WACC minus the small. So this is a growing perpetuity formula. You can go look it up. And did I type everything correctly? Yes. And if I discount that, so if I multiply this by the year 6 discount rate, well, this value here, right? So year 6 discount rate, I'm going to get the present value. So let me just erase this. It's looking okay. So if I take this and I multiply by the year 6 discount rate, that gets me the present value of that continuing value and terminal value, and the summation of this and this gives us the company's enterprise value. So this is what we've been trying to come to all this while. So this is the value of the company. This is how many? 2.387 billion naira. So that's what the company is worth. And let's check this out since it's almost done. So I'm going to just insert a filter in here and look for the NSE ASI. So insert a filter. I go pick NSE ASI. Is it still working? Something looks off. No problem. I can go grab from this one. I notice this is downloading. So I scroll through the one that has the chart where I can pick. Great. So this one, and I pick the ASI, and then I try to get the value, most recent value. That's 21,100. So 21,100. 21,100. So with these two information, I can calculate what that RM is. So using this RRI formula. So if I use this RRI formula, then RM is equal to RRI. So this formula exists in Excel 2013 and above, right? So the number of periods is just this minus. So you can use this formula to compute the cumulative annual growth rate. So this, and then the present value, what it was in the beginning of the period, and then the future value, what it's now at the end of the period, right? So this will get us this is 20-something%. Hold on. Let me verify the year NSE ASI began. So Wikipedia, NSE All Share Index begin. And Nigeria Stock Exchange Index begin. Okay, so it started 1984, not 1994. All right, so my bad, 1984. Voila. So you see 16%, and I use, what did I use? I used 17. So maybe I should just correct it all. But you get the whole concept. So that's what I used. I think the last time I did it, the market hasn't dropped. The coronavirus issue had dropped the market further. So the last time I did it, it was like 17%. But then again, that's the formula you would use if you have the proxy, like the total market index, and then you look for a really far, preferable to use long term because markets are volatile, so you don't want to pick a short duration. And then with this RRI formula, you can be able to compute the total market return and use that here. And this you go pick from a proxy that is traded on the stock exchange. Just search for it online, and you will always see this beta as free information you can pick, and risk-free rates that you know how to do. And with all of that, you'll be able to compute the DCF. So I'm going to just close this. I no longer need this. I'm going to clear. And so that's the end. Maybe I'll just leave this computation there, and I'll save this and upload. So just to do a last check to see if all is okay, I'm going to close this, expand this, take a look at this again. Is everything looking good? Turn off the grid lines. Alright, so this is looking alright. I'm going to save the video, save the Excel file, upload, and that's the end. Okay, the financial ratios is next, and after that, that's the end. See you in the next video.